Hello and welcome. Today we are pulling back the curtain on the options market. We're going to take a peek inside the machinery, see how it all actually works. And we're basing this whole deep dive on Chapter 3 of Trading Options for Dummies. So let's jump right in. So think about it. You've done all the research, you've picked your strategy, and then you click that trade button. But have you ever really wondered what happens in those few milliseconds right after? Well, that's exactly what we're going to do. We're going to follow that single order on its incredible journey from your screen right into the heart of the market. The moment you place that order, you're not just sending an email. You are igniting this super fast, high-tech chain of events. It's like flipping a switch that sends a precisely coded signal flying into this massive electronic network. And here's what that journey looks like, step by step. First, your order zips from your computer straight to your broker system, no delay. From there, it's instantly routed to one of the big options exchanges. And then, finally, if your price matches what the market is offering, bang, it's executed. We're often talking mere seconds. This whole thing is electronic, and it is built for one thing: unbelievable speed. Okay, but that order isn't just traveling through some empty digital void. It lands smack dab in the middle of a bustling digital marketplace. And this place is filled with different players, each one playing a really critical role in making the whole system tick. So let's break down who's who in this marketplace. First, you've got the public investors. Hey, that's people like you and me, but also the big institutions. Then there are the brokers. They're the connectors, the firms that give us access to the exchanges. And finally, and this is key, you have the market makers. Their entire job is to provide liquidity. That just means they're always there, ready to buy or sell, making sure there's always someone on the other side of your trade. Right, so a market this fast, this complex, it absolutely needs a solid rulebook to keep things fair and running smoothly for everyone. And one of the most fundamental rules you need to get your head around is the type of order you use. And look, this is not some minor detail you can just gloss over. Choosing the right order type can literally be the difference between a great trade and a really costly mistake, especially when the market starts moving like crazy. Now, this is a piece of advice pulled directly from the source material, and you really need to hear it. A fast market is a volatile one. Prices are jumping all over the place. Using a market order in that kind of environment is basically screaming, "Get me in at any price." And trust me, that is a dangerous, dangerous game to play. And this shows you exactly why. A market order is all about speed. It gets you in immediately, but the price you get might be way worse than what you saw just a second ago. A limit order, though, that's all about price. You set the maximum you're willing to pay or the minimum you're willing to sell for. It gives you control and protects you from those wild price swings. All right, so we've got the mechanics, we've got the rules. Now for the fun part. Let's decode the price tag itself. How in the world does an option get its price? Well, it's not random at all. It's actually made up of two very distinct parts. Every single option's price is a mix of these two things. First, intrinsic value. That's the easy part. It's the real tangible value the option has if you can exercise it this very second. But then there's time value. This is a bit more abstract. It's the extra money you pay for the potential for the stock to move your way before the option expires. It's the price of hope, of possibility, all baked into one number. So we know the price is made of intrinsic and time value. But how does that price change? Especially that squishy time value part. Well, to measure how sensitive an option's price is to different market forces, traders use a set of risk metrics called the Greeks. Just think of them as the dashboard gauges for your trade. First up, and this is the big one, is delta. Delta tells you about how much your option's price should change for every $1 move in the stock. So if your option has a delta of 0.50, it means for every dollar the stock climbs, your option should gain about 50 cents. You can see why traders are obsessed with it, right? It's their main gauge for directional risk. Next up is gamma. Now, if delta is your speed, then gamma is your acceleration and measures how fast your delta is going to change as the stock keeps moving. Traders watch gamma to see how quickly their risk profile is changing. A high gamma position can get really profitable or really unprofitable in the blink of an eye. And then we have theta. You might know this one as time decay. It's this quiet, constant force that's always working against anyone who buys an option. For buyers, theta is the enemy. It's the sound of the clock ticking down on their trade. But for option sellers, well, for them, theta is a friend. It's the potential profit they can collect as that time value bleeds away day after day.
And finally, let's talk about the big, invisible force that affects everything we've just discussed, volatility. It is the engine that drives an options time value, and honestly, it is one of the most critical concepts you can learn in the world of options.
So, how do we even measure something like volatility? Well, one way is with historical volatility. This is a purely statistical measure that just looks backward. It's like checking the rearview mirror to see how bumpy the road has been by looking at how much a stock's price has moved in the past. And what's really cool is that this isn't some super secret complex formula. As the source material shows, it's pretty much just two simple steps. First, you calculate all the daily price changes over a certain period, and then you just calculate the average of those changes. That's it. It gives you a real, concrete number for just how much a stock has been bouncing around.
So there you have it. We've followed a trade from click to execution. We've met all the players. We've learned the rules of the road. We've decoded the price tag. And we've felt that undercurrent of volatility. Understanding this whole machine is the first step. So the real question is, now that you know how the game is played, how will you play it? Thanks for joining me for this explainer.